London is being squeezed. China has silver, the US has silver, and no one is parting with it yet. And as the market gyrates back and forth, that's various parties speculating one way or the other, or that's various parties crying uncle. And that's the situation. You're literally looking at a squeeze of the London Bullion Market Association.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Okay, we're going to talk about what is going on in the silver market in our little neck of the woods. Right now, silver prices in London are trading higher than futures prices in the US and futures prices in China. That means that there's a demand for London metal and there's no supply to provide for it. It also happens to be true that China and the US, COMEX and the SGE, which is their spot exchange, have plenty of physical to sell if they wish to satisfy London's demand. The question is, why aren't they doing that? Well, the answer is that's their problem and their discretion. They may not want to sell. They may think they can make more money from it. They may think that London will pay an even higher price. And so, supply and demand is running this market right now. Why do we care about London spot? We care about London spot because the traditional supply chain for silver flowing into the world goes through London, because London is the financial hub and it has the most refiners to change forms of silver to get it in the proper deliverable form to whoever wants it. You want it on the COMEX, it looks like that. You want it in Shanghai, it looks like that. And so London has been the centralized supply hub for silver forever. Because of specifically the West's reliance on silver being refined, reminted, and formed in Europe, then when the US wants silver, for whatever reason, it will eventually come from London. Whether you buy it on the COMEX, or you buy it from a bank customer, or you buy it from a dealer, eventually it's sourced from London. So all roads lead to London forever. Which brings us to the ETF situation. Now, in the US, there's been an increasing demand for the SLV ETF. The SLV ETF, if you buy a contract of it, that SLV ETF is under contractual obligation to then set aside that amount of silver, real silver, in a vault allocated to that contract. Which means every time an American buys an SLV contract that's created, the custodian of SLV has to obtain or secure the silver. Now, there are many ways you can secure the silver. You can go into the market and buy it yourself on the COMEX. You can lease it from someone else who has it sitting around doing nothing. Or you can do what you most normally do, and that is you call London. The relationship between London's physical market and the US SLV is very deep, with an overlap of custodians and traders. So metal moves back and forth, both literally and metaphorically, between the SLV contract and the London warehouse, with the COMEX as an intermediary in between from time to time. That's how it's been for years. The excess silver that SLV taps into when it needs it is for the most part in London. And that's their supply chain. That's their feeder. The problem is the excess silver in London isn't really excess anymore. And the demand for silver in the US continues to increase for the SLV ETF. And so the London silver above ground stocks ready for delivery has been depleted substantially. And this has not happened overnight. This has been going on for years, as both China and India have slowly been taking silver out of London's warehouse, depleting them slowly. The US and our behavior is essentially just icing on the cake now. So as London's above ground excess inventory, or what people call free float silver, is dwindling to almost zero, it's harder for them to provide the services of selling because they're running out. As a result, the price of silver in London is now bid higher than it is everywhere in the world because of supply and demand imbalances. Now, when the price gets high enough over the US and over China, people in the US say, well, I have silver and I can sell it for $49 here, or I can sell it for $51 in London. Why would I not just sell it in London and buy it in the US and pocket $2 and just ship this US silver over to London? That possibility is also there for China. Is the price of silver trading under the price of silver in in London? Yes. Well, if it is, then you have a choice. Do you wish to sell your silver at a higher price? If you do, you sell it in London and you ship it there. Do you wish to sell your silver at a higher price in London and then buy it in Shanghai and ship it there? If you do, then you buy in China and then you deliver in London and make a profit. If, however, you think it could go a lot higher, you do nothing. So what you have, quite literally, is London being squeezed by the US and China at the same time. We don't know who's doing it, but it's being done. At some point, the silver will be made available. We don't know why the silver hasn't been made available yet. The answer is profits. When you want to make money, you make money. When you're a good football team in college, you run up the score when you can once in a while. The score is being run up on London right now. Has London cried uncle? Well, London's an entity, but it's made up of smaller entities. So along the way, there will be disasters, probably from bank to bank, from individual to individual, but I don't know what's going to happen there. Anyway, so at some point, at some price, someone in the US will say, this is crazy. London's trading $10, $15, $20 over the metal in COMEX. I'm just going to sell my silver in London and get a better price. If I want to sell it, I'm going to sell it in London, right? If I'm going to buy it, I'm not going to buy it in London. It's cheaper in the US. Buy it in the US, buy it in Shanghai. And so the supply demand should rebalance until the prices equalize. But it won't be smooth because of the regional barriers that have gone up in the world in this post-dollar world, in this deglobalizing world, in this mercantilistic world, if you will. So that's the whole situation, right? London is being squeezed. China has silver, the US has silver, and no one is parting with it yet. And as the market gyrates back and forth, that's various parties speculating one way or the other, or that's various parties crying uncle. And that's the situation. You're literally looking at a squeeze of the London Bullion Market Association by both the Shanghai Gold Exchange, SGE, and the COMEX, which is a feeder for the SLV. So U.S. demand for ETFs and physical going into COMEX, as well as Chinese demand, has stripped the supply, the excess supply in London, down to bare bones minimum. Again, why do we care about London? Because the London price fix is the main tool used in the world for every firm to price silver on their balance sheets. The silver fix, the gold fix, were named after the Goldfix. Those names are prices that are essentially settlement prices for firms that trade in silver and gold to carry on their accounting books for a day. So what we are looking at here is, regardless of how this resolves itself, whether it resolves itself $5 higher because London capitulates, or whether it resolves itself $5 lower because Shanghai and the US start to just sell it relentlessly to take those profits, regardless of what happens, London's ability and status as a global accounting pricing mechanism has been damaged, potentially irreparably. If you're looking for any precedent for this, we'll look at the recent history in the LME with the nickel disaster. There is no more LME because they lost their franchise, they lost their credibility. And so I would say to you, in the spirit of de-globalization, commodity pricing becomes more regional. And I've said this several times to everyone. And now I'm saying to you again, when the world de-globalizes, global commodities become regional in pricing. When regional pricing dominates in commodities, it destroys the supply chains of those commodities, which is what we're seeing right now. And in the end, it destroys the institutions that rely on those supply chains, namely the LBMA relationship with Switzerland and with the COMEX. And the odd man out in this relationship is the LBMA. Now, I'm not predicting the demise of the LBMA, although I would not be unhappy if it happened. But the facts are as I see them. And I could be wrong, but the facts are as I see them. The LBMA, which is comprised of bullion traders all over the world who operate in London, they operate in the US on COMEX and SLV, and they operate in Shanghai. They're all the same people. There's a large overlap there. All they're doing is leaving London and taking the metal with them, literally and metaphorically. The trader in London works for the same firm that trades in the US and works for the same firm now that trades in Shanghai. And all they're saying is, I'm going to take the metal here. Now, why are they not bringing it back to London? Because of the potential for profits? Well, maybe they're not allowed to. Maybe the US is hoarding metal. We can pretty much say observationally and anecdotally that China is hoarding metal. Chengtong has been buying metal for years for multiple reasons, monetarily as well as industrially. So you have to realize that we are in a war, and that war is a metals war, to paraphrase Josh Fair. Critical minerals are conflict minerals. In the old days, they didn't call them critical minerals. They called them conflict minerals or conflict diamonds or assets that were the result of conflict. We are in a global metal war. And so critical minerals are really conflict minerals. And everybody's fighting for their natural resources to propel us, hopefully, potentially, into the next era of economic growth, whether that be with silver, with copper, with lithium, with rhodium, and with gold, which is the daddy of them all because it is money. And this is what's going on right now. The prices will change by minute, but I'm giving you the dynamic for the whole thing right now. Have a good day.
Well, thank you, Vincent, for this morning's update. Exciting times out there, and great to be following along as we continue to see the gold and silver prices in record territory, almost record territory for silver. And in either case, hope you're having fun out there. And before we wrap up, did want to pass along an update from Fortuna Mining, who just released their third quarter production numbers, and they came in on target at 72,462 gold equivalent ounces, right in line with what they had in the third quarter of 2024. Of course, this was driven by their flagship Séguéla mine in West Africa. That's the one I went and visited about 2 years ago. And in addition to the gold that they're currently mining from Antien, Ancien, and Kula pits, they have a host of other targets, including Sunbird, which if you've heard any of the calls I've done with Fortuna CEO Jorge Ganoza, you know that's the one that they're really excited about. And during our last call with Jorge, he gave us an update on Sunbird and what's going on at Séguéla.
There are two very exciting things here. One is the production growth that we already discussed. where this mine is going from 140,000 ounces of annual gold production, moving up to a range of 160, 180,000 ounces of annual gold production, right? And that's on the cards. We have already provided the market with that guidance for 2026. So that's exciting to us, and the team is very focused on delivering that. And the second one is exploration, because we continue making exciting discoveries at in the Seguela camp. I call it a camp because we control 35 kilometers along the belt, and we have the Kingfisher discovery, and we have the Sunbird discovery, which is a discovery we made over 2-3 years ago now, but continues to grow. Now we are developing a case for underground mining following deeper, higher grade mineralization at Sunbird, right? And Sunbird is shaping up to be the largest gold deposit in the Seguela camp. Right. So a lot of good things on the exploration side. And I believe we're only starting to also understand the full potential of all of that belt.
Well, thank you, Jorge. Sure was great to hear that update and great to see the progress there. And in case you missed that call where he talked about Seguela and more, well, that one's coming your way now.